faithfully delivering value and interpreting the world's best books. Hi, this is Sally's Book Talk. Today, I'm going to interpret the book The Future Bank for you. The English version came out in November 2014, and the Chinese version launched in 2020. The English title translates directly to Ending Banking. It's not about how banks will evolve, but that the banking industry itself should be wiped out. The author, Jonathan Milan, is a pseudonym with two people behind it. One's a Swiss economist named Muller.
The other works at a major international bank and hid his real name for protection, showing the book's views are pretty shocking.
After the 2008 financial crisis, everyone knew the banking industry was messed up. Government reforms focused on regulatory policies, thinking that tightening financial rules would fix the banking industry. But the authors believe the problem isn't regulation. It's that banks, as industrial-era products, were led to a dead end by information tech. To prevent another financial crisis, we've got to end banking altogether. All right, I'll break down the book's main ideas using 3 questions. First, how did banks work back in the industrial age? Second, how did information technology push banks onto a path with no turning back? Third, how do we end the banking industry? Starting with the first question, how banks operated in the industrial age. Back when banks began, they handled money stuff like custody and payments. For example, a merchant in a town stored his gold coins at the bank. Then, when he bought goods from a factory, he didn't lug a sack of gold. He just had the bank transfer money from his account to the factories.
Beyond that, banks got into lending. Like if a merchant wanted more goods but was short on cash, he'd borrow 10,000 gold coins from the bank to pay the factory, then repay with interest after selling.
Bank lending led to something. It expands the money supply, a process called money creation. Let me quickly explain how banks create money. Say a town's residents have 10,000 gold coins total, all deposited in the bank. A merchant borrows 10,000 gold coins to pay a factory. The factory's account gains 10,000, but the residents' 10,000 is still there, so the bank's total deposits become 20,000, and this can repeat forever. If, Roca, quote, T. Suppose this process repeats 9 times, and the bank deposits become 100,000 gold coins, expanding the town's money supply tenfold. No matter how much bank deposits grow, the actual gold coins don't increase. It's still just the initial 10,000. But for depositors, money in the bank feels just like holding actual gold coins. In their minds, the town's money has already become 100,000 gold coins. If the town remained isolated, this wouldn't actually cause problems. Since there's only one bank in town, all individuals and businesses keep their money there. Now, when depositors buy things, they don't need physical coins. Just notify the bank to transfer funds between accounts. The trouble starts when, say, the town's factory moves operations elsewhere and tries withdrawing 20,000 coins. The bank simply can't provide that. With only 10,000 actual coins in town, neither merchants nor banks can magically produce more, making it impossible to meet all withdrawal demands. When depositors realize this, they'll rush to withdraw funds, a phenomenon known as a bank run. Once a run starts, the bank must shut down, paralyzing all business in town. Clearly, traditional banking carries huge risks. So why even allow banks to lend?
Because banks have 2 key advantages over individuals. First, they resolve information asymmetry between lenders and borrowers.
A borrowing merchant knows whether he's genuinely buying inventory or planning to abscond with the cash.
Ordinary lenders can't easily uncover such intentions.
But banks have loan officers and credit systems that vet borrowers thoroughly. If repayment ability is doubtful, banks can require substantial assets up front as collateral. The second advantage, resolving demand asymmetry between lenders and borrowers.
First, amount mismatch. Merchants need large loans for inventory, while individuals have small sums that can't meet those needs. Second, time mismatch.
Merchants need 6 months to sell goods, but individuals might need their money back in days and can't wait. For such a long time, banks can pool funds to solve these 2 mismatches. asymmetry.
Pooling means the bank sets up a fund pool like a swimming pool where deposits flow in through one tap and loans flow out through another.
This way, there's no need to match each loan to each deposit. Just maintain the total amount in the pool. Because banks have so many advantages, the business model of creating money through lending continues. But this model brings many risks to the national economy, forcing government intervention in banking. The first risk is the bank run mentioned earlier. Sometimes runs happen not because the bank made a mistake. For example, in the earlier story, the town's deposits grew from 10,000 to 100,000 gold coins. If the factory tries to withdraw 20,000, the bank can't provide it. In this case, if the National Central Bank acts as the lender of last resort, temporarily lending some coins to the town bank, the crisis can be overcome. Afterwards, the town bank can repay by attracting deposits from other regions and merchants selling goods elsewhere for cash. No one suffers losses from the central bank debt here, but there's another risk that can cause real losses: bank bad debts or even bankruptcy. For instance, a merchant borrows 10,000 gold coins from the bank but runs away with the money instead of buying goods. When this happens, it's clearly the bank's loan review mistake. The bank should bear the loss, but as a limited liability company, it doesn't cover losses beyond its capital. Well, and the bank's capital is often very small compared to deposits and loans.
In the 1970s, U.S. bank capital was only about 5% of credit assets.
That means if just 5% of loans default, the bank goes bankrupt, losing all capital and defaulting on a large portion of debt. And since bank debt is mainly deposits, bankruptcy means deposits vanish, innocent depositors suffer losses, and worse, losses at one bank can panic the whole banking industry. When one bank's failure wipes out deposits, depositors at other banks may panic and rush to withdrawal, causing a chain reaction that leads to runs on healthy banks. The solution-focused tone. Governments and central banks establish national deposit insurance corporations to guarantee small to medium deposits, preventing mass panic.
Under this policy, when banks fail, losses fall mainly on deposit insurers, and the central bank is lender of last resort. Ultimately, taxpayers foot the bill.
To reduce failures and conserve public funds, central banks and regulators must oversee banking operations. Bank regulation aims to ensure capital can absorb potential bad debt losses. Regulators introduce the capital adequacy ratio, bank capital divided by risk-weighted assets. Simply put, more high-risk assets mean regulators demand more capital. For example, with a 6% requirement, a bank holding 15 billion total assets, 5 billion government bonds, and 10 billion unsecured commercial loans. Government bonds typically carry zero risk weight. Unsecured loans have 100% risk weight, so risk-weighted assets total 10 billion. So how much capital should this bank hold?
600 million pounds. Now imagine another bank with 15 billion total assets, all unsecured loans. Its risk-weighted assets become 15 billion, requiring 6% capital adequacy.
That bank needs at least 900 million in capital. Let's recap. Industrial age banking created new money through lending but brought risks like runs and failures, forcing governments to bail out mistakes. To protect public interest, governments must regulate banks' capital adequacy.
In the 1980s, as cross-border banking grew, the G10, 10 major Western economies, met in Basel, Switzerland.
Their July 1988 agreement, the Basel Accord, became the first international mandate on bank capital adequacy. But soon, banks exploited IT advances to bypass regulations, triggering a massive crisis. Now, let's tackle the second question. How did information tech push banks onto a path with no return?
Industrial-era banks had one defining feature. Once a loan was made, the same bank saw it through to repayment.
For example, after lending to a merchant, the town bank would wait for goods to sell and repayment. It couldn't easily resell loans to other institutions. This had an upside: crystal clear accountability. The town bank knew local factories and shops inside out.
But since the 1970s, information tech changed everything.
With software and data transmission, computer-managed contracts boosted efficiency dramatically. Banks no longer waited for repayment. They could slice, dice, and sell loans for instant cash, adding flexibility. But this created a problem. Borrowers' creditors might be distant banks clueless about local economies, blurring accountability. After multiple resales, banks might lose track of who borrowed their money. Let me explain how this happens. Say the town bank issues mortgages so locals live in big houses, but some borrowers are jobless, making those loans high-risk assets. Under Basel Accords, banks must maintain minimum capital against risk-weighted assets. With rising risk assets but no shareholder funds to boost capital, how to comply? The only solution: move high-risk assets off the balance sheet and convert them to low-risk through financial engineering.
This off-balance sheet activity is called shadow banking.
Here's how it's done. First, the bank, or its delegate, creates a special purpose vehicle, SPV, a shell company with no operations or staff, just a balance sheet. In China, such companies are called briefcase companies and violate corporate law. But in many other countries, it's legal. The town bank sells its loans to the SPV. So where does the SPV get funds to buy them? To clarify upfront, SPVs can't take deposits. If they did, they'd become real banks under regulation, making the whole thing pointless. So SPVs issue bonds to raise cash, called asset-backed securities, or ABS. Then ABS is split into different risk levels for credit agencies to rate. This process has lots of wiggle room, like a high-risk mortgage alone, but slicing it into 10 pieces and bundling each with 9 others. Packaging it with top-notch loans can get the new bond rated as low risk. These low-risk rated bonds can be bought back by the town bank or sold to other regional banks. So who buys the high-risk rated part of the ABS? The answer is another SPV set up by the bank. This new SPV is still a shell company. It issues bonds based on high-risk ABS, called CDOs. But wait, CDOs get layered again. Low-risk parts bought back by the bank, high-risk parts sold to a third SPV. This nesting can loop forever. Of course, no matter what, some high-risk bonds always remain in the loop. At this point, banks use another trick to cut risk: financial insurance. Insurers collect premiums and promise to cover losses if bonds default. By now, buyers can hardly figure out what the original loans even were. They rely more on credit agency ratings to make purchases. This makes rating agencies the referees in this capital game. But these referees aren't neutral. Bond issuers pay the agencies. To help their paymasters sell bonds, agencies lean toward low-risk ratings. Clearly, this payment model is totally messed up. In fact, before the 1970s, bond buyers paid the rating fees. Whoever wanted to invest in a bond paid rating agencies for assessments, with results kept confidential, until IT and financial markets changed that. Nowadays, rating reports can't stay secret. One person buys it, and it spreads free online instantly, sticking to buyer pays with bankrupt rating agencies.
Plus, with explosive bond variety, buyers can't afford all ratings, but issuers will pay to sell their products higher.
So, since the 1980s, issuers pay, creating an ethical paradox. To survive, rating agencies compromise ethics. Thus, banks hid risks from regulators. But here, risks were transferred, not amplified. Until another player changed everything. Money market funds. For Chinese audiences, money market funds aren't foreign. Think Yuebao or bank baby wealth products. These funds match bank convenience, instant access, but with higher interest. In the West, corporations' pensions, individuals' long-shifted deposits to money market funds. So how do these funds amplify banking risks?
One key way: bond repurchase agreements.
Money market funds invest conservatively. They avoid bank loans but do repo deals.
Repo deals? Simply, banks borrow from funds using bonds as collateral.
Example: a bank borrows 10 million cash from a fund against 10 million bonds, then lends that cash for high-risk loans. Through shadow banking, it converts to 10 million low-risk bonds, then repeats repo borrowing. infinitely.
After 9 cycles, the bank's initial 10 million risk becomes 100 million risk.
If the bank goes bankrupt, who takes the loss? Now, banks' debt structure differs from industrial times. Depositors shifted funds to money market funds, shrinking bank deposits. Replacing them are repo debts owed to money market funds. Thus, bank failures hit money markets hardest. Exactly what happened in the 2008 crisis. That crisis was called a silent bank run. Not a depositor run, but a run among institutional investors. Runners included money market funds, hedge funds, and banks holding off balance sheet bonds. As an individual investor, you might have felt nothing initially because the Fed bailed out banks pre-collapse, shielding retail investors. Pre-AT industrial era saw bank runs and failures as distinct concepts.
Pure runs involve no bank fault, just cash shortages fixable by central bank loans, whereas failures,
though often triggering runs, stemmed from bank mistakes. Following punish the wrongdoer principle, governments let banks fail while deposit insurance protected small depositors. But in 2008, runs and failures blurred together. Surface view, banks held low-risk bonds, suggesting a pure liquidity run. Reality, the crisis rooted in banks' reckless lending, hidden via shadow banking. Problem, letting banks fail would crush money market funds, uninsured yet backed by innocent small investors. Beyond banks, insurers guaranteeing risky bonds would collapse, jeopardizing public health or property safeguards, forcing central banks to rescue both. Ultimately, the guilty escaped punishment while central banks printed money to socialize all losses. Let's summarize. Information tech brought a seismic shift. Credit assets now rapidly transfer between banks and financial institutions, spawning massive shadow banking. Since shadow banks aren't real banks, global banking regulations became useless.
this triggered the 2008 crisis, forcing central banks to print money for bailouts, making society pay for banking errors.
To prevent repeats, 27 countries signed the Basel III Accord in 2010, raising bank capital requirements. Actually, Basel was updated in 2004 pre-crisis with new risk assessment standards, but who enforces them? Having regulators handle everything is unrealistic. The answer must be banks and rating agencies themselves. That's ironic, like vault guards stealing the gold. So the police solution? Make the thieves reinforce the vault door. The authors argue no regulatory upgrade can solve
Banking's crisis in the information age.
Basel III still sets low capital adequacy, just 7%.
Banks operated with minimal capital for decades. Raising it now would hurt the economy.
Worse, regulations still target only banks, ignoring shadow banking.
Actually, the root problem isn't banks. It's creating money through credit. So the book proposes ending banking entirely by targeting this model. Now, the final question, how do we end banking? The authors suggest banning money creation via credit for banks, shadow banks, and all institutions. Specifically, require non-financial assets never to fall below liabilities. How is this different from current corporate finance rules? The key is non-financial assets. These are assets exclusively owned by one company, like cash, offices, or equipment that can't appear on another's books. In contrast, financial assets can appear on multiple companies' books simultaneously. For example, loans are classic financial assets, listed as assets on banks' books and liabilities on borrowers' books. The proposed policy aims to prevent financial assets from circulating between different balance sheets. Let's return to our town bank example with 10,000 gold coin deposits. For simplicity, assume zero capital.
Under this new policy, how much can a merchant borrow?
Zero. Because bank liabilities equal deposits, 10,000 coins, lending even one coin would make non-financial assets fall below liabilities.
Banks must either stop taking deposits to become credit platforms or rely on their own capital as investment firms.
Thus, banking would be completely eliminated. After banking's end, who handles payments and lending? The authors propose completely separating money and credit, the two pillars of finance. Money becomes public domain, managed by central banks. Credit becomes commercial domain, handled by market-based lending platforms.
First, money.
Under the gold standard, gold reserves couldn't keep pace with economic growth.
Hence, commercial banks helped create money. But in today's fiat currency era, central banks can create unlimited money instantly, making commercial banks obsolete for money creation. Physical cash required commercial bank networks for distribution and control, but digital payments changed everything. Central banks can issue universal digital currencies, CBDC, with wallets for every citizen and business. All payments and storage would happen through these digital wallets. Monetary policy would execute directly through wallets. When expansion needs more money, central banks distribute unconditional income to wallets. When inflation looms, they charge liquidity fees to reduce money supply. Second, lending. Banks' advantages in solving information demand asymmetry can now be addressed by technology. For information asymmetry in the internet era, credit activities generate massive data. With the right algorithms, lenders can fully assess borrowers. For demand asymmetry, Fintech can slice or recombine loan amounts terms to perfectly match lenders and borrowers. Banks aren't needed. Any algorithm-savvy lending platform can handle this. But reality shattered ideals. Peer-to-peer lending implemented this direct matching model recently and ended in chaos. Globally, especially in China, countless peer-to-peer explosions caused massive losses. So far, peer-to-peer models have basically failed. So is this book's grand vision equally unreliable? The authors argue peer-to-peer failed not because the model was flawed, but because tech alone can't dismantle banking's power. Post-2008 bailouts set a dangerous precedent, governments paying for banking mistakes.
Since then, people believe all bank products have government backing, freeing banks to chase high-risk, high-return deals, sometimes matching peer-to-peer yields. What's to help?
People quickly realized peer-to-peer could lose everything, while banks guarantee principal and returns. Thus, P2P couldn't compete, doomed to fail. Some platforms even fabricated loan projects to retain investors. So ending banking isn't technical, it's political. Only government enforcement of the book's proposal, requiring non-financial assets greater than or equal to liabilities, can end banking. With banking gone, lending platforms could finally show their true potential. Final summary. Banks organize money or credit, creating money through lending, which breeds financial risk. In the industrial era, financial regulation could control risks. But with IT advancement, shadow banking grew uncontrollably, making financial regulation ineffective. Thus, the authors suggest governments should end banking through new financial rules. Separating money from credit. Replace banks' monetary functions with central bank digital currencies and lending functions with credit platforms. Only this can prevent another 2008-style financial crisis. Clearly, the book offers deep banking analysis but faces huge political implementation hurdles.
Apparently utopian, yet Western financial media and economists, like former BIS chief White, praise it highly. He wrote a provocative review. Read this immediately.
This book dares to think big, demands reform. Today's global financial system needs deeper, more nuanced thinking. But like the authors, daring to think is daring to act. That concludes Sally's book talk on The Future Bank. Reading notes are below the audio. See you next time.